Breaking news. With Outsurance, you always get something out. News Leader, proudly brought to you by Outsurance.
Welcome back. Now, Discovery has delivered a strong set of interim results. The financial services group reported solid growth in new business, a sharp contribution from Vitality, and continued strength across its South African operations. Discovery said its Vitality shared value model has positioned it uniquely for continued growth. CEO Adrian Gore joins us now to unpack that performance. Adrian, thank you so much for your time today. We're seeing strong growth across both Discovery SA as well as Vitality, with the bank turning profitable ahead of schedule. Walk us through the drivers of that performance and how the group managed to continue to deliver double-digit growth even within this volatile and uneven economic environment.
I think, look, fundamentally, the Vitality shared value model that underpins everything we do has been really executed well in every business. So if you look at the actual results across the two composites, Discovery SA and Vitality, the businesses within them all outperformed what we'd hoped they'd do. So the actual efficacy, how the model works, how it affects people, how it affects pricing, how it affects profitability has worked remarkably well. There have been some standouts. I mean, Discovery Bank has just really accelerated its acquisition of clients. The quality of what it's done has made a massive difference. In the UK, our business has really shot the lights out. So there's been a number of standout performances, but to an extent, I put it to you that the operation of the uniqueness of the model has made it very, very competitive in most markets, South Africa and globally, and that's been at the core of the growth.
You talk about the uniqueness of models, and is that what we're also seeing play out when looking at new business value?
Yes, it is. And we tried in our presentation there to show that we can actually quantify the so-called kind of the alpha, the extra margin or profitability created by the model. So when you look at that, especially in the life insurance businesses, we're measuring new business value. That is what's driving that excellent return on capital and what's driving the margin. And you can now quantify it in different parts of the value chain. It's kind of can be calculated and demonstrated, and I think that's the power of what the 6 months has illustrated for us.
Yeah. Adrian, now you've spoken about AI reshaping the economics of insurance, and the launch of Vitality AI with Google seems to be a defining moment. Practically, how does this shift Discovery from being data-rich to truly AI native, and how defensible is that advantage?
Well, I think the Vitality shared value model, in its simplest form, is trying to incentivize people to manage their health better, manage their driving better, manage their money better. Getting people to do the right thing in the right way, especially with health issues, and to provide the right incentives is a complex problem. And if you can get that to happen, which we have done at scale, it makes a massive difference. So Vitality AI is about using what we have unique data, using that together with Google to actually deliver complete personalization at the point of kind of using our products. And for us, it's defining in terms of our own businesses like the Discovery business or Vitality in the UK, but it's also critical in our partnerships with insurers around the world, the ability to offer them that capability. It allows us to make them more effective. It allows us to bring more partners onto the platform. So it is very, very defining for us. It was a very big launch for us globally during this period.
You talked about partnerships there, and just recapping some comments from your presentation, you said that the group isn't looking to spend big on new initiatives, and I'm wondering whether that is a shift into organic growth.
Well, in the past, and we tried our best to get this across, over 10 years leading up to 2024, we spent a lot of money on building new businesses like Discovery Bank. It was a very good strategy, but it's very expensive. Now we're seeing the benefits of that. So we have essentially in the Discovery Group and Vitality, we have a range of businesses that are coming to scale now, like the bank, that offer massive growth, but we don't need to invest in new initiatives, complicated J curves that cost money. The investment now is actually getting them to scale. The investment is in things like Vitality AI that at what we're spending, it's a lot of money, but given the scale of the group, it's actually not. So I think we're in a phase now, and that's what we're being clear about. We've said that we can grow at 15 to 20% a year for the 5 years to 2029. We made that kind of that guidance in 2024. We're on track to achieve that without recourse to capital. And I think given our size, if you can go at 15 to 20% compound without capital, that's really good going. So we're feeling good about it. We've kind of shot out of it at the moment, but we're still comfortable with that kind of that level of prediction.
So I'm assuming then that capital allocation, CapEx, over the financial year is basically just being spent on scaling then?
That is correct. Within the business.
Adrian, perhaps let's look at what's playing out on the international front. A pretty mixed picture when zooming in on some of the regions you're operating in. Over in the UK, there's pressure in the UK healthcare system. In the US, there's volatility. And then we are seeing slower growth in China. How are you managing those dynamics, and where are you seeing the strongest momentum?
It's a great question. I mean, the reality is, one of the underlying realities of the world is that spend on healthcare tends to just increase. The demand for healthcare tends to go up as populations become more prosperous. So ignoring the volatility of the day, that is one of the underlying bedrock issues that drives the group. And you can see that taking place everywhere. But in each of the countries, there's a unique trade-off. China's got difficult issues, but government is promoting health insurance. The UK has difficult affordability issues, but the NHS is under threat, and therefore people are demanding health insurance.
Okay.
Life insurance is big, but capital returns are poor. So I don't think we can claim or excuse ourselves from volatility. Our role is to manage the volatility, and our model works well in this environment. So I don't see any excuses outside of absolute catastrophe. But within those bounds, we should perform well.
All right, being able to control what you can control. Adrian, let's leave it there. Thank you so much for your time and taking us through the 6 months that was for Discovery. That was Adrian Gore, CEO of Discovery.
Breaking news. Switch to Outsurance Business Insurance and get a 20% discount. News Leader, proudly brought to you by Outsurance.